Wall Street gears up for bank earnings and testimony from the US Central Bank's chief. Welcome to Market Insight. I'm David Pollard. Hopes that the recent stock rally will broaden beyond big tech will be put to the test this week as second quarter earnings season kicks off. JP Morgan, Citigroup and Wells Fargo get the ball rolling on Friday. Meanwhile, investors are looking forward to Fed Chair Jerome Powell's Congressional testimony and key inflation data this week, seeking to bolster bets for rate cuts to begin in September. Well, joining me now to share his thoughts on all that is Peter Andersen, CIO of Andersen Capital Management. Welcome, Peter. Let's start with Jerome Powell. He delivers his testimony to the Senate Banking Committee starting tomorrow. Is the pressure on him now to strike a dovish note?
The pressure has been on him, I would say, ever since he started raising rates. So this is not new to him. He's very much versed in navigating this very, very fragile narrative about trying to do what's best for the economy, but also trying to appease those investors that have been pounding on the table for months now about having rates lowered. So I think he'll, as usual, do a masterful job. I don't expect him to actually give us any additional insight, but he will do a thorough job. And at the end of that, the markets will probably still stay the same. That's the problem with all this, is they speculate about what actions he'll take, what he'll say, but we have to be very careful to ever literally interpret any of the phrases that he's going to say this week.
Now, the testimony comes against a backdrop of softer labour market data, according to Friday's non-farm payrolls report, which shows unemployment ticking up to 4.1%. What are you seeing in the labour market, and does it give scope for earlier rather than later cuts, or does the onset of the US presidential election put paid to those ideas?
So many moving parts in this. You know, this is the worst time to actually speculate in a cycle, especially with the presidential election, about what the Fed will do. You know, first off, I think in a presidential election, the Fed tends to be on hold. So let's assume that's as a baseline. But then all the other issues you mentioned, you know, everybody is closely looking at every single data point about the labor market and all other CPI, et cetera, that always comes out periodically. So this is a calculus that everybody has been struggling with, but I personally think that the Fed will not lower rates through the end of this year and probably through the next half of last year. People have forgotten that rates now are really not abnormally high. Historically, they're probably normally average. So we have to put that in perspective. I know we would like rates to be lower, but we're like children wanting to go out in the rain and looking out the window and saying, oh, it looks like it's cleared now. Maybe we can go out and play. But we have to realize you have to get total trend of clearing before you can actually go out in that backyard and play again.
Well, of course, the next big data point in this whole debate is of Thursday's inflation reading, which is followed by the University of Michigan's sentiment index on Friday. What's your assessment of the US consumer and of price pressures at the moment?
The U.S. consumer, it's very, again, I hate to hedge, but it has been very difficult to get a comprehensive picture of the U.S. consumer. If anything, it seems like they are so-called bifurcated, where there is a large class of consumers that are doing exceptionally well, but then there is another class of consumers that are doing very poorly. So that tension between those two extremes continues to play out. But in general, I would say when you average all of this in, the consumer tends to be doing very well compared to COVID, of course. And prior to COVID, I would say we are almost on the same track as we were prior to COVID, which is great news. And I think the Fed has done a remarkable job navigating through these changing cycles. But in general, it's very hard to give a global picture of the U.S. consumer right now. Very challenging.
Let's move on to this week's big earnings story. US banks with JP Morgan, Wells Fargo and Citigroup all coming up on Friday. Higher interest rates and economic uncertainty, they have weighed on the sector, but are things starting to look up, do you think, for the sector?
I think so. You know, one of the several good things, and believe it or not, there are some good things about what people are calling higher rates, but what I would call average rates, is that it tends to make the business of banks do better because of their lending and then borrowing rates. So the difference between those two, if the rates are higher, generally that means that banks will tend to be more profitable than they were, say, when rates were virtually zero. Not a lot of people have focused on that aspect. They seem to be continuously pounding on this mantra of when are we going to get lower rates. So I would say if there were the case of rates going lower, and we'll have to hear what the banks think of this because, of course, their economists are very much focused on this also. If they expect banks to be lower, then I wouldn't be surprised for their stocks to trade off because, of course, that would signal that their profit margins would be decreasing in the future.
And as we go into the second quarter earnings season, how crucial is the AI story to the continued momentum for US share markets this year? Is there simply too much hype around AI?
The AI story has eclipsed almost every sector out there, hasn't it? And of course, there's always a danger when we get so overloaded with one topic. However, it does appear we are now starting to see some of the early benefits of AI. You know, this build out that has been going on, and it is still in the build out stage, I think that puts a lot of pressure on the show me stage. In other words, once the build out is completed, how is this going to benefit the consumer? How is it going to benefit profit margins, et cetera? We're still waiting for that, but we are starting to see now, for instance, if you had asked me 6 months ago about that, I would have a less optimistic outlook on the build-out results, but now we are starting to see that. And I would say that AI could probably carry us to a higher market at the end of this year. It is remarkable the technology that has been emerging, and I do think we're just starting to see the beginning of that.
Okay, Peter, it's been great to be talking to you today. Peter Andersen of Andersen Capital Management. Many thanks for sharing your thoughts with us. That is Market Insight. We have more videos on Reuters.com.